Green Rush, Mining the Energy Revolution with Matt Watson.
Hello, welcome to Green Rush, Mining the Energy Revolution, the program that focuses on precious and critical minerals as they impact us through this clean energy transition. Today's topic, clean energy transition metals, and looking at this periodical table that I have on the screen here, you can see all these metals that are critical, that are playing a role one way or another. And there's only two metals on this table that are losers in this proposition, palladium and rhodium, and that's today's topic. So help me in welcoming Mr. Jonathan Butler from Mitsubishi Corporation. Jonathan is the head of business development and precious metals sales and marketing. Jonathan, welcome.
Hey, Matt, great to be here.
Fantastic. Glad to have you. I want to just point to some material as we talk through this subject matter. And I'll give you my worldview, but Jonathan, please chime in as you see fit on any one of these topics as we walk through this. First of all, the PGM basket as a whole is one that I would characterize as being under some strain. You know, right now we're seeing palladium and rhodium falling over the past 2 years. There's accumulating surpluses that have been going on. And really, when you look at the long-term outlook, palladium and rhodium are really going to be challenged. Today, over 85% of their demand goes into gasoline and diesel engine, ICE engine, catalytic converters for emissions control purposes. So palladium and rhodium, I think, are pretty clearly the losers in this proposition. Jonathan, would you agree with that?
I think generally I would agree with that, Matt, with a couple of caveats, perhaps. First of all, don't discount the risk of South African supply shocks, whether those be in the short term because of electricity supply issues or potentially operational issues or even labor issues, as we've seen in the past. And in the longer term, of course, the rationalization and closure of some of the older, deeper level mines, which will have an impact on the whole basket, but also on palladium and rhodium. But I wouldn't disagree with the general move, as you say, towards a surplus for both palladium and rhodium over the longer term. I think we've still got a little bit of life in the old internal combustion engine for quite a bit more time. In particular, in relation to increased hybridization, and we can talk a little more about that later. But also this electrification that is seen as being baked in isn't necessarily the case, I think, as you've alluded to in previous episodes. And there's a few interesting dynamics going on with respect to the relative valuations of palladium and rhodium, which may create some opportunities in the longer term.
Fantastic. Now, you know, when I look downstream, you look at the hydrogen economy, both fuel cells and green hydrogen electrolyzers, even ammonia fab and ammonia cracking, platinum, iridium, and ruthenium, 3 platinum group metals are the key in that space. So it's a bit of a shift, if you will, in demand from platinum, palladium, and rhodium and catalytic converters to platinum, iridium, and ruthenium and these other hydrogen economy applications. And really, I think the long-term forecast, you know, from every analyst I've talked to, that we're seeing long-term outlooks for increased demand on those 3. Would you agree with that?
Right, absolutely. I mean, these are the 3 critical materials for the hydrogen economy: platinum, iridium, and ruthenium. And probably of those, ruthenium is increasingly interesting because it can be used to substitute iridium to a degree in PEM electrolysis. We're also seeing some use of it in fuel cells. And then there's also this potential to use ruthenium in ammonia cracking for storage of green hydrogen at scale in the form of ammonia, an inert, relatively easy to handle, and certainly a material that we've got a long history with in terms of long distance transportation. So I think in that sense, ruthenium might be the sleeper in all of this. And it also helps that it's currently the most inexpensive of those 3 metals.
Agreed. The only hope I could see in the ruthenium demand is there are 2 applications today that are going to, I think, diminish over time. One of them is the hard disk drive, rotatable memory that uses a significant amount of ruthenium. We see that being displaced with solid state hard disk drives over time. You know, basically hard drives full of flash memory, getting away from the platinum and ruthenium. So there's a chance for some relief in that present day demand that may offer a little bit of wiggle room. And then also, I think there's a question about thick film resistors. Can there be a transition in technology there to base metals? freeing up some of the current day ruthenium demand to new applications downstream. So there's a little bit of slack in ruthenium, where I don't see that slack in iridium and platinum. Those two are very much, I think, committed demands and committed supply demand pictures, if you will. Do you agree with that?
I think some of your own forecasts, Matt, have alluded to this. The big chunk of additional platinum demand that we're going to see in the years ahead, not just in the electrolysis of water to create green hydrogen, but also in that distribution and storage piece. In particular, things like liquid organic hydrogen carriers, and then, of course, the downstream use of platinum in fuel cells, but also potentially in things like e-fuels, which kind of relate to the whole green hydrogen story. And we can't take anything for granted these days. We're already seeing some of the funding being delayed, and in some cases, some projects not being implemented. But I think that long-term story is going to keep platinum well supported, is going to grow some really interesting new demand areas. And then iridium, similarly, as you mentioned here on the slides, this is a tiny market relative to those, certainly to platinum or palladium. And it's already fully accounted for in a lot of the existing applications. So, we have to think very carefully about how we make that one work over the longer term.
Absolutely. Then you look at the forecast for PGM mining. In a nutshell, I think some of the older South African mines will start approaching end of life and go into maintenance mode. These are the deeper half-mile to mile-deep shafts penetrating both the UG2 and Merensky reefs. You look at some of the newer age mining coming out of North America, Russia, Zimbabwe to the north of South Africa. All of these regions are palladium-rich deposits, not platinum-rich, but palladium-rich deposits. And because of that, you look at the forecast for the supply downstream, man, it sure looks like there's a lot of the wrong stuff. We need more of the platinum and the ruthenium and the iridium. More palladium doesn't necessarily help the cause at this point.
Right. Yeah. And I think on top of that, Matt, we've got the whole recycle story, which is primarily a palladium and rhodium story, given the dominance of those metals in autocatalysts. So yeah, of course, that's going to contribute to those longer term surpluses in palladium and rhodium, unless, of course, we can re-engineer some of this clever new technology to use palladium and rhodium. These are chemically very similar elements, and we've seen that interchangeability in many other applications, notably in autocatalysts over the years, but also in some of the newer chemical applications, as we're already starting to see. As I say, iridium replacing ruthenium. The other way around, ruthenium replacing iridium on the basis of cost. But I think to your point about the longer term supplies, I think we're all pretty convinced of the argument that the longer term outlook for the South African mining piece, especially on the Western Limb, is for lower output as those older mines come to the end of their lives and are not necessarily replaced. And then the newer mines, typically on the Northern Limb, open pit, slightly different prill splits there. So there's a lot of challenges ahead, I think, for palladium and rhodium.
Now, you and I both work in communities filled with all of these recyclers around the autocatalyst and PGM recycling space. Of course, their eyes are watering. They're looking forward to playing a more significant role if we are indeed going to be this tight with iridium and ruthenium in particular. What opportunities exist to accelerate and capture even more metals in the recycle streams?
Yeah, that's right. I mean, some of the unique challenges of processing things like membrane electrode assemblies, catalyst-coated membranes, all these weird and wonderful bits of very clever technology, which pose some unique material challenges. I mean, I think these are going to keep our friends in the recycling industry very busy for a long time as we figure out optimal ways to recover these metals through pre-treatment, through different refining technologies, and ultimately, the role that companies like Mitsubishi play in financing this whole piece. We tend to say it's the kind of the three R's: recycle, re-engineer, and risk manage. Because the risk management piece, particularly if we are to see rising prices in those metals like iridium and ruthenium, there's some potential there to do things a little bit differently, to lease the metals, to forward hedge some of that price risk, and of course to get that metal back into circulation as soon as possible so it can be used in these new applications.
Okay. Let's take a look at some of the movements. So as it relates to these autocatalysts, platinum, palladium, and rhodium, these are the three metals that end up in your catalytic converter for emission control systems. Platinum, as most people know, only about a third of the supply goes into autocatalysts, where palladium and rhodium historically have been well above 85% of their total supply goes into this one application. So it makes sense as we see a slowdown in some of these ICE vehicle sales that you're going to see a slowdown in the basket price, if you will, here. And indeed, that's what I take away from this. I think the drop in palladium and rhodium came much earlier than I anticipated, just because the car sales volumes post the COVID pandemic have been down so dramatically. It's accelerated the timeline as to when this downward transition would occur. But nonetheless, it's here, and we've seen palladium, lose half its value, and rhodium that not too long ago touched $30,000 a troy ounce is sitting there at about $4,600 a troy ounce today. So quite a drop in circumstances for those two metals. Any comments here that you'd like to make?
Yeah, definitely. I mean, I'd go back to that earlier point that there is still life in the old internal combustion engine. We saw for the first time after several years of double-digit percentage growth, electrification, that is pure BEVs, actually go slightly into reverse. I think they were 15% of the global market in 22, and in 23 they were 14%. So that growth is not necessarily being replicated. I think we're coming up against challenges of material availability in the battery space, also electrification infrastructure from the large-scale grid infrastructure to the charging points that individual households would have available. And of course, consumer choice playing a big part in all of this, particularly given that electric vehicles are typically quite a bit more expensive than conventional vehicles. So, back to that point, I do think there is life in the internal combustion engine yet, in particular through hybrids. We've seen the Biden administration start to promote hybrids and kind of dial down some of the more positive rhetoric towards electric vehicles. And we're seeing that in other markets as well. In Europe, some of the internal combustion engine bans have been delayed out to the mid-2030s and may still be delayed further. So ultimately, that still means there's going to be a role for palladium and rhodium in all of this. I think as well as that, we've got a whole bunch of interesting technologies waiting in the wings for a price level that would then stimulate the greater use of it in chemical applications, in oil refining applications, particularly palladium. I'm talking about here.
Right.
So yeah, I would agree generally with that move lower in terms of demand, and we still have that tail risk of electrification taking away some of the palladium and rhodium demand, but there is still life in it yet.
Agreed. Let's get into a little bit more of the detail. Anglo American, they published this in one of their operations reports. I think it's a nice summary. There's a magic line in the sand around 2018, 2019, where some new test protocols went into how they test these catalytic converters and the actual emissions. They do a dynamic real-world testing now, where they take each powertrain model from each OEM, and they run it for several hours over hill, over dale, in a dynamic mode, and that reveals a different level of emissions than they had seen before. And as a result of that, they're using higher loadings of PGMs per vehicle. And it's astonishing how much more. Since that break, the outlook on gas is some 17% higher. Diesel is higher. It's not shown here, but even hybrid vehicles, to your point, Jonathan, are 10 to 15% higher loadings. People often ask me, why is that? Well, it ends up one of the most strenuous points for emissions with your vehicle is when you start your engine on a cold morning in your driveway. That's where the highest spike in emissions comes from. And the only thing worse than starting a car in your driveway on a cold morning is having a hybrid that starts on electric. You get on the freeway, you're doing 50 or 60 miles an hour, you run out of power, the engine turns on at speed. Well, that's even more strenuous. And as a result, it's driving hybrid loadings higher still. And so, yeah, there's this bonus for hybrids that are actually pulling higher amounts of PGMs. And yet, with all that said, the numbers for car sales, I think, are still the story. And let me just move to the next chart to illustrate this. here's a nice summary from Bloomberg. You look at the aggregate car sales, we were close to 93 million or over 93 million in 2017 pre-COVID. We have yet to touch that level again since. And I think this is the kind of the macroeconomic piece that is not discussed enough, is that the vehicle sales are profoundly down. We saw some 23% shift in the baseline on this trajectory that we were on for vehicle sales. And so yeah, there's a percentage now that are plug-in hybrids and full-range BEVs that chew into this detriment even further, but it's the car sales that are off the most. Would you agree with that? That's the greatest influence that's driving this basket around on its prices.
It is, absolutely, Matt. I mean, you just look at that fall off, even before COVID, that peak in 2017, 2018, 2019, the market globally was already in reverse. Part of that was China, of course. Big part of that, and then 2020, relatively speaking, a collapse in car sales, of course, because of the COVID pandemic, and then the recovery from that was exceedingly slow. 21 and 22, of course, we had the long shadow of COVID manifested itself in the chip crisis, and once that was overcome, guess what? We're in a much higher interest rate world than we were pre-pandemic. Getting up towards 5-6% for the longer dated interest rates in many countries. And that has an impact on vehicle refinancing rate, on the fact that a lot of vehicles are bought now on leases, and people coming off leases for their old vehicle don't want to pay the upfront cost of a vehicle that's much higher given the higher inflationary environment, and certainly don't want to have their monthly payments spiked up because of the interest rate changes. So, all that's contributed, I think, to this very slow ramp up back to pretty much, what levels were happening a decade or so before. So this kind of long tail of COVID, these figures don't necessarily show it that clearly, but there's something like a 10 million unit vehicle delta between where things should have been had we not had pandemic and the chip crisis and everything else, and where we actually are now. And those are vehicles that just simply weren't made. And incidentally, that has quite an influence on the long-term recycling market, because there's going to be a kind of missing generation of vehicles that aren't coming through the recycling stream in the longer term. But I think another great thing about that chart, Matt, is it shows the proportion of electric vehicles, which has grown very strongly, but is kind of reaching some sort of limits right now. But at the same time, a slightly less aggressive growth is that of plug-in hybrids. And back to your point there, the need for light off from cold start is what's driving those loadings higher. For many years, up until sort of 2018, 2019, there was this big move towards engine downsizing, and that was generally reducing unit loadings. And then we see the advent of hybrids, plug-in hybrids especially, and the need to deal with that more frequent cold start. So those loadings crept back up again. And of course, we had Euro 6. I think on your previous chart, you mentioned Euro 7, Matt, and that's a kind of interesting one, because in every previous generation of emissions control, we've had a step change in loadings necessitated by more stringent NOx, more stringent particulate matter, the other regulated pollutants. And Euro 7, as it's just very recently been published by the European Commission, is kind of none of those things. It's keeping everything more or less as it is at Euro 6. There are a few new changes on emissions, things like tires and brakes, but that's not a PGM forcing technology, nor is it really an emissions in the traditional sense from an engine. So we've sort of started to hit the limits of how far the legislation is going to drive loadings much higher. There's still a technology choice, particularly on hybrids, that could do that, but Euro 7, overall, bit of a non-event for driving those PGM loadings higher.
Right. The other thing I want to comment on is just the length of this trough, right? It's taking a full decade out of these car sales. And to your earlier point, if you can imagine this trajectory here, if we were to have continued that trajectory, we would already be well over 105 million vehicles this year. And that is a huge difference. If we were actually selling those vehicles, they would almost all be hybrids and ICE incrementally, and would really make a big impact to the market. And so, again, just stressing the point, it's the vehicle sales, I think, is the primary lever that's hurting the PGM basket at this point, more so than the EV or the electrification penetration rate. I wanted to move on and show one more chart here on breaking down China. China, the largest vehicle market in the world. And here you can see a very profound drop. Of course, the electrification in China is the highest of all the various nations. Their penetration rates are quite high. You know, when people talk about, is there a chance for the hybrid volumes to come back and help recover this PGM basket? I always answer, it comes down to China. What is China? How is China going to respond to this? More so than the U.S. and the EU. Are they going to curtail their EV builds? I really question how much they're going to be able to curtail that. But the drop, the drop in volume here is profound, right? It's the typo here. Let me change it live. 11 million, 12 million vehicle drop from 2017, where we should have been climbing higher still. It's a huge 35% decline in ICE that we're seeing in this market. And that's I think what's hurting the most in terms of electrification is China. Would you agree with that?
Yeah, I mean that's very clear from this chart, Matt. All of that against an overall declining market, I think is the first thing to say. We've still seen that huge growth in the market share and absolute levels of growth in EV sales. I think what we've got to underpin is that a lot of that. What we've got to remember is a lot of that is underpinned by the promotion very aggressively by the Chinese government, by tax incentives and subsidies, and a real effort to build a domestic value chain in battery manufacturing and also battery electric vehicle manufacturing. And those vehicles are now being exported around the world, relative cheap price points. We're seeing a large influx of them into Europe and into the US as we speak. But I wonder, is that growth that you see there in the chart sustainable once some of those de facto subsidies start to get removed, if those de facto subsidies start to get removed? And can we see double-digit rates of growth of new electric vehicles, as they're termed here, in an environment where we're already seeing, potentially several millions or even, well over 10 million vehicles going each year? Maintaining those double-digit growth rates is very difficult once the absolute number starts to get as big as it is now. What I would say, though, and this gives me optimism for the long-term future of the car market, whether that's partly electric, but also with some hybrids and some ICEs in there, is that China's car ownership rates are still extremely low when compared with developed markets. I think it's something like 50 vehicles per 100 households in China. That compared with, I think it's 188 vehicles per 100 households in North America. So essentially 2 cars for every household. We've got half a car for every household in China. So that implies a huge amount of potential growth over the next few years. And it's the same story in China. India. India's figures are slightly lower than China's. So there's a huge nascent growth potential in there. And the other thing is, we've tracked this quite closely at Mitsubishi. KPMG do an annual survey of the global automotive industry. They ask a bunch of questions to 1,000 leading auto industry executives, and they compare the responses year by year. And one of the questions is, what is your projection of EV penetration in the various markets by 2030? When they ran the survey back in 2021, all of the responses were pretty much 50-60% EV market penetration by 2030, whether it was China or Europe or North America. And when they reran that survey in 22, those figures had roughly halved. Now, what had happened in the meantime, of course, we'd had that big commodity supply shock and that energy supply shock after the Russian invasion of Ukraine. So suddenly everyone's focused on energy costs and whether that's sustainable in this environment. But then when that survey was rerun in 2023, it's interesting, there had been a bit of a move back to EV expectations being higher, but only to the extent of about 30% for each of the main markets.
Right. A much slower growth rate going forward. Absolutely. Agreed.
Right. Exactly. And as you see from these figures, we're getting on for that 1/3 of the market already in being EV. So I do wonder about the limits to growth. And that's before we get into questions of material availability. Where's all the lithium and cobalt and everything else, all these wonderful other metals that you cover in your show? Where's it going to come from? How are we going to recycle it effectively and keep it going through the supply chain?
You know, it's funny. I was one of the first analysts standing up in 2018, starting to scream that this EV transition was not going to occur at the pace that was being promoted, and all just highlighting all the hype. And really, the fundamentals that the mining is the constraint, right? How quickly you can turn the mining wheel from exploration to development of the mine to, productization and ramping a mine. It's taking longer than ever, and turning that wheel and lithium and nickel and cobalt and manganese, all the metals for the battery space, is really going to be one of the constraints as to how fast that EV penetration rate can grow. And so, yeah, I clearly it's going to be slower going forward. It will climb, but I think it'll be slower going forward for sure. Let's talk a little bit about the recycle. You've talked about this, and again, you and I live in a precious metals community that's very much focused on this huge recycle market. All of our vehicles get recycled, and the key component they want to grab first is the catalytic converter. It contains these platinum group metals. And here I show a long-term chart on palladium as it's used in the autocatalyst market. The lighter background trend here is the gross demand that goes into new builds. And then this darker trend on the bottom here is the recycle stream, what do you harvest from those vehicles as they go into life. Beyond 20 years of life, these cars are ending up in the scrapyards and being harvested. And so there's a lag, if you will, from initial builds to the recycle. And yet this recycle is clearly going to climb and keep climbing going forward. And you put that in the context of the overall supply. And here on the right-hand side, I show my forecast for, the South African decline that we're talking about. Here's the Russian, there'll be some modest growth from Russia and Norilsk, North American mining, PGM mining, Zimbabwe. But look at the green piece here, this recycle piece that I'm talking about. It's just a huge amount of supply. I was rolling some numbers this week. I was coming up with numbers of over 125 million troy ounces of material. What if by 2050, without new demands for palladium, and there will be new demands, but if you didn't have new demands, that could be some 13 to 15 years worth of supply. So again, putting stress on the fact that the market needs to develop new applications for palladium to take up this slack and take advantage of this in what should be a surplus market for some time to come. Would you agree with that assessment?
Well, I think I would certainly agree that it's the gift that keeps on giving. Palladium Autocat Recycle has been consistently contributing 2 to 3 million ounces a year. And for a long time, the market needed it. This was a 6 million ounce a year primary mining market. And when demand was running at 8 or 10 or 11 million ounces a year, we sure did need that recycle. And it is the gift that will continue to keep on giving, because as older vehicles come off the road, they tend to have relatively high palladium loadings because they reflect the fact that 15, 20 years ago, the OEMs were putting palladium on there to meet the then emissions targets. And of course, collection and refining networks are getting better all the time. And for a long time, up until, perhaps last year or a year or so ago, when prices were much higher, that was really driving that recycling. So yes, it is going to continue to grow, and it's going to bring metal back to the market, whether we like it or not. Just like primary mining of palladium. Well, no one opens a mine just to mine the palladium. You're either getting the platinum out of there primarily, or you're getting nickel or the base metals out of there. So it's the kind of the accidental PGM in that sense, that it comes out whether you like it or not. And it's the same with the Autocat. So we do need to develop new applications that are going to absorb some of these forthcoming surpluses. And as we've talked about, some of that will be re-engineering of this rather similar chemistry that we've seen in some of the new applications. I think there's an interesting point regarding the autocatalyst market even right now. There was a lot of speculation at the start of this year as platinum and palladium were approaching parity. Palladium was looking like trading at a discount to platinum for the first time since 2018, and we very briefly saw them cross over, but it's not been sustained. Our forecasts are that they will eventually, palladium will go into a discount. Now, might that stimulate greater use of palladium in autocatalysts than even we see today? Well, it could do, but we all know the auto OEMs take a little while to re-engineer their catalysts. They don't just move on the spot price. They tend to like to see a nice track record before they make those big moves. And that happened the other way around back in 2018 when palladium was more valuable than platinum for the first time, and it took about 2 years for the big OEMs to and catalyst makers and miners as well to come out with more palladium rich. More platinum rich catalysts in that case. Whether we then see a wholesale move the other way, well, first of all, I don't think these three-way catalysts have been adopted in a wholesale way. There has been some move towards the more platinum rich catalysts, but it's not happened at every automaker. It's not happened in every region. So there's potentially less of a switching to be done. Also, all the OEMs are focused on the electrification issue right now. They're not putting huge engineering resources into reformulating their catalysts. It's more or less the electrification that they're focused on rather than on catalysts. And of course, Euro 7 and equivalent legislation around the world isn't really giving that demand kicker, as we said earlier. So is that additional demand going to come from palladium and autocatalysts? Some, for sure, but it's not necessarily going to be that big move when it was back in the 2000s, early 2000s, as you see on your chart, when the first palladium-rich catalysts were coming onto the market. I think those days are sadly behind us.
I agree with all that. And finally, let's just wrap up with a quick discussion here on the mining outlook. I grabbed this slide from a Northam ops package. All the primary PGM miners in South Africa declining. Right-hand chart here, I have a mix of the basket coming out of the ground. It's dominated by this pinkish color platinum, then palladium, and then these more PGMs, rhodium, ruthenium, and iridium. You'll look at all the other PGM mining that's active in the world today, and it's, we labeled it platinum group metals back in the day, but if you were to do it again, maybe you'd label it palladium group metals because these are palladium-rich deposits, each and every one of them. And then you look at, what's on deck? What are our greenfield or brownfield projects that are on deck? And again, you see they're stacked up, mostly palladium-rich deposits are on deck. And again, just adding to the situation. So that's kind of the supply picture behind the scenes. Getting anybody from a platinum PGM mining investment community interested in expanding Western and Eastern limb mining in South Africa is a very, very tough sell at the moment. Man, I just don't see the supply picture having a big influence on swinging this discussion much. Jonathan, what are your thoughts there?
Yeah, I mean, as we said at the start, Matt, I think that there is that tail risk event that could happen. It could be from strikes, it could be from electricity supplies, it could be from maybe one or more producers just simply choosing to close mines more aggressively than has already been planned. But those kind of tail risks, although they do bring potential upside to the price and tighter markets, they tend to be quite temporary. Right. I don't think anybody's wishing that we had an electricity supply crisis in South Africa or that there's any other operational issues. I mean, mining is difficult enough at the best of times, and we really don't want those sort of black swan events making things even more difficult. So yeah, I guess for the time being, there's going to be that steady attrition as older mines are closed, and as you say, we move away from some of those more diverse ore bodies and tend to get more palladium and maybe a little bit more rhodium in some of those. So we're kind of stuck with the prill split. We're kind of stuck with the hard rock geology. It's you're going to get the metals that you don't necessarily need as part of the mix, and that includes palladium and rhodium. So I think for the producers right now, it's extremely challenging. They're dealing with all-in sustaining costs, which are way above where the basket price is today, as you indicate. There has to be some rationalization over the coming years, and that's going to lead to a lower supply base. That's going to put more pressure of course, on the markets in general, and it's going to mean that recycling has to step up in an even bigger way than it is already potentially. So it's going to be an interesting few years. But as you say, those growth metals, those platinum, ruthenium, and iridium, there isn't a lot of those, particularly ruthenium and iridium, as you highlight there.
Okay. Well, thank you so much, Jonathan Butler, Mitsubishi Corporation, again, the head of business development and precious metals sales and marketing. Appreciate your time, sir. Thank you so much.
It's been a pleasure. Thank you very much, Matt.
Yeah, thank you so much for joining us this weekend for Green Rush, Mining the Energy Revolution. Really appreciate your time. Next week, we're going to be talking about silver, a very crucial metal in the electrification of everything. It's a metal that I would characterize as one that's becoming more of an industrial demand precious metal. Plays a critically important role in solar PV, as you may know. So we're going to have a special guest, Mr. Phillips Baker, who's the president and CEO of Ekla Mining Company, the largest silver miner in North America. He happens to also be the chairman of the Silver Institute. So we'll have some conversation about that role as well. So please join us next week as we continue this conversation about Green Rush, Mining the Energy Revolution. Take care, everybody.
Green Rush, Mining the Energy Revolution with Matt Watson.